Valens Research, Uniform Financial Analytics.
You don't know, obviously, the Chicago Mercantile Exchange, major exchange company, right? Futures, options, etc. So when you look at this chart, the first place that we always bring anyone who comes in to look at any individual company under uniform accounting, the first page that you always land on is this page. This page is what we call the performance, the PVP, or performance and valuation prime page. Looking at this page, you can see there's 5 different panels. The first panel is ROA prime. And so ROA prime, this panel is really about performance. And you can notice it's very hard to see here, but if you look back here, you can see orange bars here next to the blue bars. Those orange bars, which by the way still even exist in 2008, if you can see, the orange bar has a as reported ROA of 2% versus our uniform adjusted ROA of 80%. The orange bars are the distorted as reported ROA for this company. What the as reported metrics make you think this company's real performance is. The blue bars are the true blue uniform accounting returns for this business. What this business has done historically when we remove all the accounting noise. Right? And what's so powerful when we look at CME is CME in this example, right, isn't a 2% ROA business that basically is generating returns that are a third or less of what its real cost of capital is. This company is throwing off an 80% ROA. Right, and that before we even get to the rest of what we're going to talk about for CME, and we'll talk about for each of the other companies, that alone is so important to understand when you're looking at CME. If you look at CME from an as reported basis, you would wonder, is this a company that really has an economic moat? Is this a company that really can generate strong returns? Do I want this company investing in more exchanges and innovating on its current platform? I would argue you'd say you don't, right? If you've got a company that's generating a below cost of capital return, a weak return like 2% returns are, you've got a company that really should not be growing its business. In reality, you'd be thinking wrong things about CME if you looked at that. You think it's a bad business, it should be shrinking, I should avoid it. And certainly, you'd be thinking it shouldn't be trading at multiples in excess of what the market is trading at. But that's not all. There are a bunch of other important insights that we can see when we use uniform accounting and we use the performance and valuation prime chart. Once we get beyond looking at these blue and orange bars for ROA, the rest of this chart is these light blue bars are what sell-side analyst estimates, when we take consensus Wall Street estimates, and we actually convert them into the uniform accounting framework, what they say the analysts are forecasting returns for the company to be going forward. Right. So in the case of CME, right, the market basically analysts, I should say, expect returns for CME to drop a little and then actually rebound, right? Remain level at these levels at around 80%. Then these white bars at the current stock price for CME are what the market is pricing CME to do right now. So at the current valuations for CME, this helps us understand what is it that the market thinks CME can do, right? If we look at CME at a right now $188 stock price, earlier this week at $180 stock price, the market is pricing in CME to see returns rise from 80% to 220%. Right? And that's really powerful because that can help us start to understand, all right, when we want to think about if we think CME is a buy or not, we need to understand what does the market think? Because if the market is already pricing CME to have phenomenal growth and strong returns, well, even if we think that's the case, CME is probably not undervalued. But if we think CME is going to continue to have flat returns, right, around 80% going forward, and the market thinks it's going to have 220% returns, well, that actually might be a short candidate, if anything. But it's not just looking at ROAs. We also want to look at asset growth, right? Asset growth is the exact same thing. The orange bars are the distorted, as reported asset growth for the company. Well, the blue bars are the uniform accounting adjusted true blue asset growth for this company. And you can see there are multiple periods over the last couple of years where as reported growth has been directionally wrong for this company. 2004, this company didn't shrink by 40%, it grew by 40%. 2006, same idea. Same with 2013, same with 2016. There are multiple times that as reported metrics have completely misrepresented the real growth trends of this business. And then we can also look and we can see, right, what analysts are forecasting and what the market's pricing in, right? And basically the market's pricing in no growth for this business with returns to accelerate. The next two charts, if these two charts are about performance, which they are, right? The idea of these two charts is about understanding how is the company generating returns and what is it reinvesting those returns into. You can really think of these two charts as basically, if you were to combine them, they represent the free cash flow generation of this business, right? But in a more thoughtful way, because you're breaking that free cash flow generation into, are you a good business and are you reinvesting in your business? These two charts are about valuation. They're about understanding how much does the market pay a premium for your business or not. The first chart is uniform accounting value to asset prime ratio versus the as reported price to book ratio for a company. Our VA is an adjusted price to book metric. So when it's high, that says the market is paying a premium for this company relative to its asset base, generally because the company is generating a strong return on its assets, so it should be a premium. But you can see when you're looking here in terms of the as reported metrics, the as reported metrics are so really almost irrelevant here. And that's what's so important with looking at the uniform accounting metrics. But way more important is actually looking at the uniform accounting PE, which is our VE prime versus as reported PE. And with CME, you can see one of the really important things that's jumped out about CME the last 3 years. CME's valuations are a lot higher than as reported metrics would make you think. As reported metrics would make you think that CME is currently trading at a 30 times multiple. It is a highly valued company, but it's not exceptionally highly valued, right? But in reality, this company is trading at a 50 times multiple. It's almost 2.5 times what market average valuations are. That's exceptionally high in terms of valuations. And the last chart we have here is TSR relative to the market. What does that mean? TSR is the total shareholder return a company generates, right? When you combine the stock price performance of a company on an annual basis and the dividends the company throws off. TSR relative to the market, TSRR. TSRR means we're going to compare that return relative to the market's return, right? To the index that's most relevant for this company. For CME, that would be the S&P 500. So when CME is flat, like it was here from 2009 to 2010, in terms of TSR relative to the market, that says that that CME's stock performance was in line with the market's performance. On the other hand, when it rises, like it did here, that means CME outperformed the market massively. When it falls, as it did here, that means CME massively underperformed the market. What you see is over time, there is a very strong relationship between TSR relative to the market and a company's real uniform accounting performance, in a way that you don't, by the way, see when you look at the as reported metrics. If you were to remove this period right here, 2007, 2008, which for CME had to do with some capital markets activity that they really couldn't control, and you were to look at the TSR trend of this company, you'd see as uniform accounting ROAs rose and fell, so did the TSR. Why? Because that's what the market's paying attention to. And so if we look at CME, and now we understand all those things, so now the question is, what do we think CME is worth? Right? We can certainly see that right now if we think CME is basically going to grow at 0% at a $180 stock price, the market expects ROAs to expand to 175%. If we look at this, we can say, well, CME did do that historically, but certainly the trend in the last couple of years says that they probably aren't going to be able to do that again. So what happens if we think that that's too aggressive and we think that CME really isn't going to grow organically like they haven't, but ROAs are going to plateau at 80%? We can use the embedded expectation tool, which is a useful tool we have here in the Balance Research app, to do a quick scenario analysis. And we can see if we expect this to happen for CME, returns to basically stabilize at around 80% going forward with no growth, this company has 60+% downside. It's not worth $173, it's worth $75.
Balance Research, the world's leading source for uniform financial analytics.